Hello, I'm Adam Grimes, and welcome to Market Life Chart School. So in these videos, we're usually looking at examples of patterns, whether they're setting up, working out, failing. The point is usually to understand how a pattern plays out in isolation. And we'll frequently say things like context matters, context is really important, but that context is a little bit harder to understand. That's what today's video is about. So I got a note last night. This is being recorded in the middle of the day, February 7th, 2018. I got a note from one of my private coaching clients, Pascal, who said that he listened to my comments where I said swing traders would probably have a difficult time putting on positions. And I'd suggested that in the current environment, the right thing to do was either to be a very short-term trader, holding things for 1 to 3 days maybe, or a very long-term investor where you're holding things for multiple months to perhaps years. And he said, well, wait a minute. I found this example of a failure test pattern. So let's look at that failure test pattern. This actually is a very good example. So here in CCE, we have the failure test around this previous pivot. And you can see what happened. My line's not perfectly straight, but we took out the lows, had a good reversal. And then he also has very impressive one-day follow through. So this is a good entry. And his point was that, is this a strong enough pattern that despite the concerns about the context, I should take the trade? Well, let's talk about that context. So the context is, if you're watching this right now, you're very well aware, but if you're watching this later, you might not realize we had a market. Let's just kind of go bar by bar here. We had a market that for many months has been historically strong. There are all kinds of measures of how overbought, how strong the market is, hit historical extremes. Volatility was at a historical low. Complacency might have been very, very high, probably is still in some regards. And the market just kept going up. So this was a very easy market. And then what happened was, you can see as this develops, a brutal reminder that the market can be extremely volatile. And we had an immediate return within a couple bars to very high volatility levels. And then the market seemed to find some kind of bottom. So that's the context. We've had a very strong market. They got hit very hard. Now what happens? Well, typically when a stock market gets hit like this, we see some type of pattern like this. It usually involves some type of sideways consolidation and then a retest. What happens on this retest? That's a little bit up for grabs. It's entirely possible that we retest this low and go through and continue to make lower lows. Could very well be the end of the long-term uptrend for a while. Or it's equally possible that we test those lows and snap back. And in fact, if we go back over the last several years of stock market action, this is what's happened. Every time the shorts have gotten even sort of a setup, it's been erased on the retest. So that's what we expect as a baseline scenario. We expect to kind of consolidate, hang out somewhere in this area, probably retest the lows. Of course, there are other possibilities. And one of the things that makes market action complicated is that really anything is possible. It's entirely possible by the time I finish recording this video, we'll be at new lows. Now, it's possible. It's not likely. In fact, it's exceedingly unlikely, but it's possible. And it's also possible that we'll just rocket back to new highs like this never happened. Also very unlikely, but possible. So this is kind of what you have to go through. This is context. You have to map out the possible outcomes, and you need to have some sense of the associated probabilities. This does not, from a quantitative perspective, you can come up with precise probabilities, but even those are suspect because the answers you get are going to depend on exactly how you look at the problem. If we just taking these last, 40 or 50 bars, there are hundreds of different ways we could crunch the numbers, look at patterns, and we'll find very different probabilities. So even those very finely tuned, very quantitative perspectives they're a little bit suspect because they're a lot suspect because, first of all, the limitations of statistics and probability, but also the fact that the answer you get is highly dependent upon how you ask the question. So in this environment where we are expecting as a baseline scenario to kind of hang out here, have a lot of back and forth, I suggested this would be a difficult time to put on swing trades, that the correct course of action was to play for exactly what you see happening on your screen here, these 2 to 3 day snapbacks. So if you're a mean reversion trader, you can very likely play both sides of that. That's a specialized game, and the time to figure out a program like that is not in this environment. You should already have done the work, and you should be that kind of trader. You don't want to become that kind of trader now, or to be the kind of person who buys things as things decline and knowing that you may very well go significantly underwater, but you're holding for years or sometimes even decades. These types of spikes down provide very attractive long-term entry points. But for the swing trader, we're likely to have some problems. So that is why I suggested, in terms of context, we wanted to avoid swing trades. Now, Pascal finds this entry. What are we to do with this? Well, so I would suggest, yes, first of all, this is a good entry. And now we need to turn our attention to trade management. And I think this is very simple. If you're in an environment where you don't really trust the market, where you don't really expect impressive follow-through, what you need to do is not give the market the benefit of the doubt. And one easy way to do that is to trail stops more tightly than you might usually. Another way to do that is to take off exposure as you get some profits. Now, you need to be careful with that. You don't want to be the kind of trader that takes off profits. You put on trades and risk dollars, and as soon as it moves in your favor, a few ticks or a few pennies, you want to ring the register on some of that. That's probably not really a winning strategy. And I've argued that I think one of the problems with learning to trade is that profit taking is actually quite difficult. But when you get a reasonable profit, maybe half of your initial risk, certainly at 1 times your initial risk, maybe you take off more of the trade than you typically would. You trail stops. Certainly, you can find trades that set up against the context, and you can have successful trades, but I think you need to adapt your trade management style. And that's really the message here, that the pattern, this is a good example, it's a good standalone example of an oversold entry that is further motivated by a failure test in a market that's also probably finding a bottom. It's a great trade. Pascal found a great trade. But I think the real lesson is in how you manage trades in this type of environment. And you can adapt this. We're talking daily time frame for a stock, but you also could adapt this. Let's say you're a 5-minute trader in currencies. Well, then your context might come from the daily chart, might come from the hourly chart. And if you're taking 5-minute trades within that context you don't trust, mechanically it's very similar. And the impact is on trade management, how you get out of trades, both at a profit and a loss. That really matters. So a few thoughts on context, and also, maybe a trade idea you can steal here, but certainly some ways to think about the current market. And it's one thing to think about it in the abstract, but think about what it means for your practical trade management. MarketLifeTrading.com. Thank you very much.